Hello and welcome to our latest investment update as of July 17th, 2020. I'm Mark McCarron, Wescott's Chief Investment Officer. In today's agenda, we're going to focus in on the market update through July 17th and also a virus update. There's been a lot of news recently on the new cases. We'll take a look at that and again revisit our outlook for the second half of this year. So quick market update through today. The U.S. has unfortunately posted a single-day record of new virus cases, this time more than 77,000. And that's reported for yesterday by Johns Hopkins Coronavirus Resource Center. And the continued rise in these cases could absolutely delay the reopening and threaten what we're seeing as a nascent recovery so far. And to that point, large banks reported this past week that they set aside billions of dollars to address the potential for loan defaults, which is a serious thing, and we'll address that issue later in the conversation. However, while that's fairly bad news, I think a good news is that while cases continue to rise, there has been some progress on vaccine development. And as that continues, that bodes very, very well for a full recovery, as we've talked about in the past. So what we wanted to do in today's update is look again at the stock market in the U.S. As represented by the S&P 500. We've been tracking this very carefully for the full year, showing actually at the end of yesterday's close is that the S&P has indeed erased all losses for the year, which is hard to believe, following a very strong recovery in the second quarter and so far in July. But we also want to take a look at broader market indicators. So not only the S&P, which represents the US stock market, but the Vanguard total stock market, which is a little bit broader than the S&P, very similar construction, but also the Vanguard total international stock market, which is a good representation of the world outside the US. And the Vanguard Total Bond Index, which is a portfolio of bonds that are investment grade and high quality, and represents really the component in client portfolios that is designed for stable return and income generation. So first, Vanguard Total Stock Market. So we're showing that here in the blue. It took a dive just similar to the S&P 500 in the first quarter, but has recovered. And it too is fully recovered. Its losses for the year is up 0.2% as of yesterday. As we talked about before, it's similar constructed as the S&P 500. Its top names include Microsoft, Apple, Amazon, Facebook, and Alphabet. And it's a benchmark that Wescott uses as a proxy for the broad US market, albeit large cap. The Vanguard Total International Stock Market has also had a very strong recovery after a fairly significant decline in the first quarter. That's shown in the gray line here. And while it's recovered dramatically in the last couple of months, it's still down minus 7.2% year to date. What I thought we'd do also is just take a quick look at what's underneath the Vanguard Total International Stock Market. So its top 5 positions are given here. That's Alibaba Group, Tencent, Nestle, Taiwan Semiconductor, and Roche Holdings. So Alibaba Group and Tencent are 2 Chinese technology companies. Nestle is a well-known food producer. Taiwan Semiconductor is in the technology sector as well, and Roche Holdings is a drug company. So this is a well-diversified global portfolio, but it's dominated here, at least in the first 2 positions, by Chinese technology, which does show I think the changing nature of emerging markets and why we have allocations outside the US. And we've seen recently Chinese stock markets start to recover from its decline in the first quarter. And finally, the orange line here, or the yellow line here, shows the return pattern of the Vanguard Total Bond Index. It's up 7.1% year to date. It's been the best performing asset class across all equity indexes. It's made up of government and investment grade bonds that have maturities between 5 and 10 years. I think that's important because Wescott builds portfolios that have an allocation to US, non-US, and the bond markets, so that the balanced portfolios that we're seeing have benefited from that stable allocation to bonds, while also benefited from the recovery in the equity markets. And year to date through the middle of July, I'm happy to report that Wescott balanced portfolios have also recovered much of what was lost in the first quarter of this year. So that's a pretty strong recovery. What's it based on? Well, I think it's based on improving economic fundamentals. So we have two key indicators here. One is industrial production, which is shown in the blue, and the other is consumer spending, which is shown in the orange. And what we're showing here is 10 years of year-over-year growth in these indicators. And so the blue bars show that industrial production, which is really manufacturing activity, has been bumping along here around between 0 and 5%. It did decline in 2015 and 16, but recovered nicely up to 5%, but has fallen really close to minus 15% over the last 1 year as a result of the coronavirus-related lockdowns. The important thing here, though, is that while it declined dramatically in the first quarter, it's starting to improve. And in the last couple of readings, in May and June, we're seeing positive 7, 8, 9% improvement month over month. So we have still some way to go here, but this is an indication that perhaps the worst is behind us. The same is true on the consumer spending side. You can see that drop was dramatic in the first part of this year, but some signs of improvement as people go out and start to spend a little bit more than they did in May and April of this year. So why is this happening? First, the employment situation is in fact improving. We also think that the federal economic recovery payments that were made in April have started to have a positive effect. And we're seeing that in consumer spending specifically. The Federal Reserve also has kept rates low and will continue to keep rates low, and that's supporting the economy in general. And a piece of news we got this week, which really does highlight that impact, is the 30-year mortgage rate is now below 3% for the first time, which is a huge support and very positive for the future of the housing market. There are challenges ahead. While all that's great, we continue to see daily cases continuing to rise. This will likely lead to delayed reopenings and a slower recovery than otherwise would be. There's likely to be some targeted lockdowns in certain parts of the country to control and contain the spread of the virus. And we're looking very carefully at the changing consumer behavior, what consumers are spending on, what they're not spending on, but also the impact on the commercial real estate market, whether office space or retail space will be the same going forward. And there's a lot of research and a lot of expectations for that, and we continue to monitor that very, very carefully. Just to note that the commercial real estate exposure in a Wescott portfolio is fairly modest. Its allocation is in the REIT sector, and that REIT allocation has been reduced over the last was reduced about 12 months ago, really in anticipation of a strong, it had a very strong market and strong performance, but going forward, we were a little concerned about the ability to persist at that level. So finally, just a reminder, as we come up with our third quarter outlook, our investment commentary will be published next week. And the key themes there are, first and foremost, despite the rising cases of the virus, state and local governments will continue to try to limit the spread without imposing severe restrictions. And that's really the key to continued recovery. Also, very important is that the banking sector that reported this week does have more balance sheet capital available, and that's because of the credit crisis of 2009 forced more capital requirements, and they're better able to address this current crisis as a result. We're also seeing that a rebound in the economic growth that we're seeing today may support recovery in cyclical sectors and also non-US markets. And we did see the non-US market recover quite nicely in the second quarter and so far in July. Then finally, as we enter into the fall, the upcoming US presidential election, we think will continue to be another source of uncertainty and could potentially lead to more market volatility. First, national polls as of July 15th show Biden leading Trump, although this could change by November. And we highlight some of the sources of that national poll result below in the details here. But I think what's really most important is that both presidential candidates recognize the importance of getting the economy back on track. And the market is looking at real policies, whether it be tax policy, trade policy, infrastructure spending plans, and monetary policy. That's really what's going to drive markets. That's really what's going to drive the economy. And that's really the focus that we have in portfolio allocation and investment outlook. So with that, thank you again for your interest and your trust in Wescott. As always, please do not hesitate to reach out to me or your advisor if you have any questions. Thank you.